Happy Friday. So in my last video, I overviewed my general Miller momentum strategy and, of course, named it after myself. Need to build a brand, alliteration, and all that. I also alluded to the fact that I had worked out different variants of that basic balance strategy, which you can see right here, but for different risk profiles. So these different risk profiles are going to roughly follow the glide path that you might see in a standard target date fund, like, Nuveen's Life Cycle 2055 target date fund. Um, the type of funds that are usually defaulted to invest in by your employer. But here, I have swapped out the global equity portion for a global momentum strategy, and then the traditional 40% of the 60/40 portfolio goes to alternative trend following strategies. So last time I overviewed the balanced allocation, which is what I'm using in my accounts right now, but there are other allocations: conservative, moderately aggressive, and aggressive. Aggressive would be perhaps if you're really young and you have a huge investment timeline, you're, like 40 years away from retirement, or alternatively, if you're very content with taking risks. It's got 80% in global momentum equity, and then just 20% over here in alternative trend following strategies. And then at the other end of the spectrum, for somebody who might be in retirement, you've got the conservative allocation, which really shrinks the equity down. So you've got a total equity allocation that's fairly small here. So, for US, you've got just 20% allocated to US equities. Wait, no, 18%. My apologies. I can't math this early in the morning. And then you've got another 12% over here. So, it's just about 30% of the portfolio. And then you've got a gold yield ETF, some bond allocations that are not your traditional sorts of bonds, but work very well together. Um, EDV long term treasury strips. Then you've got mortgage based securities interest only strips that perform very well during inflationary periods, which are going to be um, with the periods where a retired person's portfolio is going to get the most damage. And then you've got catastrophe bonds, which are really neat. Catastrophe bonds are insurance linked securities. Different organizations, companies, even countries will buy insurance policies to cover catastrophic damages during things like hurricanes and earthquakes and that kind of thing. And catastrophe bonds are a way to offload some of that risk onto the general retail market. So you help pay the principal down, and then you get a share in those insurance premiums that are paid on a regular basis. And the only time it dips is when there's a payout for a natural disaster. So this is completely detached from market cycles. So, with that being said, how do these allocations actually work in practice? There is a site called testful.io, kind of a pun on testfolio, that I love to go to test different ideas and allocations. And as you can see, I've got a lot of different portfolios that I experiment with, saved just to backtest and see how things work. Here's the momentum balanced allocation. You can see right here that I've got it switched so that you've got some funds that are slightly older. So instead of CTA, you've got DBMF. Um, So that's an older managed futures fund, so you can get um, more back testing history on that. So Freedom is the ETF that's going to limit us most because it only goes back so far. But let's take a look at how my Miller Momentum Balanced Fund performs compared to a standard 2055 target date fund. And let's assume that you're starting with $10,000 and you're putting in maybe $300 quarterly. So that would be $100 a month. So going back about 7 years, you can see that the balanced allocation for Miller Momentum, it very much outperforms the target date fund. And that's because it's using momentum based strategies on the equity portion and trend following on the bond portion instead of just following static asset allocations. You can see back here during COVID, the drop on the Miller Momentum Fund was a lot more shallow than the target date fund. And you can see right up here on the max drawdown, the drawdowns for the approach that I'm taking are roughly two-thirds that of a standard target date index fund. The volatility is much better, which means your Sharpe ratio is much better and your Sortino ratio is much better as well. If you look at rolling metrics, you can see that blue line is the 60-month rolling return on the Miller Momentum Balanced Fund, and it's consistently above a target date fund that you would get from, say, Vanguard or Fidelity or Schwab. Now we can take this back a little bit further by substituting Freedom here for just putting it more into our Invesco's international momentum for the developed world. So this is going to underestimate what the historical returns should have been because I don't have the Freedom ETF loaded into this testful interface. The creator hasn't put that back tested index in just yet, but this will get us an approximate view of how things would have gone going back 10 years. So going back 10 years, you can see we're still getting about 1 to 2 percentage points per year ahead of a standard target date fund. And the max drawdown again is just two-thirds of what you would get from a target date fund. The volatility is much improved doing a trend following approach. Our Sharpe ratio is substantially better, and our Sortino ratio, which is volatility, but ignoring volatility on the upside, it's pretty darn good too. We look at our rolling metrics, and again, the blue line is almost always above the red line of the target date fund. Now, let's see how the balanced, the moderately aggressive, and the aggressive compare. Again, we're going to switch out this Freedom ETF and just put it into IDMO so that we can get the full approximate back test here. And I'm even going to add the S&P 500 in, so you can get a view of how things compare relative to not only a target date fund, but everybody's favorite large cap American fund. right. So we've got the balanced allocation at the top, our moderately aggressive, and then the S&P 500 and the target date fund. At the aggressive level, you can see that my strategy is actually slightly beating the S&P 500 over a window of about 7 years. Now we can go back a little bit farther because I think we've got a more modern ETF in that last one. So let's try this again and go back a little bit further. There we go. So again, going back 10 years, it's pretty on par with the S&P 500, which is surprising because again, here the Miller momentum strategies, they're not allocating everything to equities. You've got managed futures, you've got gold, you've got active long volatility exposure through the CAOS ETF. So that diversity really pays off because when you look at the volatility, even on the most aggressive allocation for Miller momentum, the volatility is 4% less than the S&P 500, and you're still getting comparable returns. It's less, far less than the target date fund. I mean, 1% is significant, and it's vastly outperforming that target date fund. Even the balanced Miller momentum allocation with a volatility of about 11% is outperforming your standard Schwab, Fidelity, and Vanguard target date funds. And it's doing it with a greatly reduced amount of volatility and drawdown. Taking a look at the rolling metrics, again here we see that the S&P 500 is in the lead, but that makes sense because the last 10 years have been really good for US large cap. But right behind it is the Miller Momentum set of funds. And then you've got your standard target date fund on the very bottom here. So it can be a very rewarding strategy to take that standard target date fund and replace the equity allocations with analogous momentum funds. So, for large cap, you would use SPOMO. For mid cap, you would use XMMO, etc. And then replace its bond allocation with a diversified set of alternative trend following strategies. Works out very, very well. So, that's what I wanted to show you today. I understand that there is a bear market going on right now, so, uh, keep your food tied up high in the trees, I suppose, out of reach of all of those bears, and just keep holding and hanging on. I'll catch you next time.